Welcome to Next Move with Travis and Eric, and it is episode 13, and it's March 13th. We're recording this, and well, 13 has a very significant meaning to my life and the rest of it, but I'll put that aside and really get to it. I'm your host, Travis McGregor, and as always, my co-host, Eric Maloney.
Hi, Travis. Hello, Evan.
And our distinguished guest here is Evan Dreyer from Northern California. And Evan, say hello, please.
Thanks for having me on, Travis and Eric. Big fan of the show. I'm looking forward to talking today.
Beautiful. So we have talked, in the narration of the last 12 episodes have focused on, and I'll boil it down to some general concepts, is that, you know, the argument, the philosophy, the framework of what we're talking about here is that we have seen great digital transformation in cloud, and it's accessed so many people and changed lives for the better, and access to money and payments and all those things in the world. But what it fails to do is that all the CPUs and the microcontrollers and these phones and so on are not secure from a tamper resistance. And so at every single level of cloud infrastructure, when you don't have software and hardened security and hardware, is you have vulnerabilities. And as we've seen, almost like tearing away from the headlines almost every day, it seems that 1.5 billion stolen from a compromise in cloud authentication to get to some crypto wallet. Now, blockchain's interesting. It's only a very small fraction of the problem out there. And we're seeing all the time that what we thought in two-factor authentication and multi-factor authentication and everything else is that we are not binding the relationship to hardware. And that's really where the SIM and eSIM come into, and other type of forms such as smart cards. But for this purpose, we're really focusing on that. And for this episode, we're going to get a little bit narrow here. We're going to be granular in the sense of focusing on a market vertical, and we'll see where it goes from there. Private credit. We've seen the mounting of all this capital in private credit firms because a lot of times the banks, Basel II and III, they need more cash, opened up a huge opportunity. And I'm a big fan of getting money to the people that need it, both consumer or small to large businesses. It runs the world, if you know. And I'll start with this very high level, expansive question of private credit. Evan, you're a risk person, expert in all this. What are you seeing out there? What are the horror stories? What's happening day to day and all this lending of money? Give us some insight.
Well, I think a lot of different directions to take that. First and foremost, let's go to where the water is originating from. Why is private credit growing? And I think you mentioned a very astute observation with what banks are doing is really transforming, and there's a few different dynamics there in terms of why are banks kind of getting smaller? Why has more stuff kind of gone to the private side? And that's impacted private credit, venture capital, et cetera. As regulations rise, banks have had to divest businesses. They've had to refine their customer base. All of a sudden, they're not trying to get any customer because the bar of compliance is going higher and higher. So not only is private credit growing because there needs to be a place to put these assets to work, but where is private credit growing? What type of customers are utilizing private credit? And from my standpoint, I'm coming from Tola, where we're working with small businesses, B2B financing, and those businesses are always perpetually underserved because for the big banks, it makes less and less sense to sharpen their pencils and do the underwriting versus a much larger company. So you've seen this wave of financing and private credit kind of infused financing to the fintech space. And that has been a huge opportunity for growth for technology companies, but also for the private credit industry. If you look and follow some of the fundraising of fintechs, especially on the lending side, a lot of times there's a private credit firm standing behind them that is giving a debt facility, that is giving them a warehouse facility that's doing venture debt. So when we think about scaling our financing offering, those are the conversations we're having. We're having conversations not just with the big private credit firms, but some of these smaller, more startup shops that are really specializing in going and understanding it. Now, there's a lot of different dynamics and ways we take it here, but for me, the interesting part of this is how risky is this new world that we're going into in terms of, okay, it's great that we have the capital that wants to get put to work, but how do we do it? How do we actually find these people? And I think there's a lot of excitement around what we can do with data and automating parts of underwriting. I mean, I'm dating myself perhaps a little bit here, but in the past, if you wanted a loan as a business, you'd walk into a branch bank and you would meet someone and you would show up with your financials and you would be in your accountant's office and you'd have to have that relationship, or you'd be, it'd be someone, you'd be golfing with someone and you'd meet them that way. And that's just not how businesses are financing themselves now. They don't have that branch relationship because the banks have pulled back. So they're going online, they're finding it. We will put, us, like many of our competitors, will put ads out there, and that's how people are finding how to finance their business. And that doesn't mean, hey, these aren't great customers. A lot of times we find amazing customers that we don't meet in person, right?
All right.
That just because of that flow of information, I think tools like Plaid have really transformed what's possible, because with an API, with a connection, you can get insight. But I think what we've also seen is that there was a lot of excitement, a lot of desire to deploy capital, and a lot of these early lending companies in the fintech space from kind of 2017 to kind of 2018 plus, they suffered a lot of losses, and the fraud was very high, and the underwriting, it was tough to be precise. And so I think there's been, and what that led to is just rates going higher, right? That's how you don't want to
That's how you cover.
You just need to make more return. You need to be, risk and return always have to be viewed in tandem. So I think that what we're seeing on the ground with private credit is there's a lot of capital to be put to work, but there's an increasing desire for precision. And how do we know who this person is? Because especially when you talk about SMB lending, you're talking about the difference between someone who's a real business and someone who's pretending to be a business. It's harder and harder because these are two-person operations. It's not something that you can look up their Bloomberg and look up their 10K or 10Q like when I was working on Wall Street. A lot of this, you have to have different tools. You're using different databases. You're using different risk management platforms out there. I think another huge signal for the market, for me at least, has been this huge wave of all these risk management and KYB companies that are sprouting up across the industry, focused on fraud and doing well. And so I think that that's a response in a lot of ways to private credit coming into the market, and those private credit holders saying, hey, we need additional precision. We are going to raise the bar. Just because you may not be regulated like a big bank, we're going to be the ones who essentially are regulating you. And when we design a credit box and what we do. So I think that that's been a great win for the early stage industry, is having all these sophisticated private credit operations. Private credit underwrites, they know how to underwrite companies. And so when they show up to the fintech space, they're able to make sure that these companies are doing things the right way, have good hygiene, do reporting. A lot of companies, the first time they're doing a lot of this stuff is to get a private credit deal. And to take it even further, there are now companies like Finley and Arc that are technology that is helping fintechs do debt raising. So that's how big the private credit space is getting, is that there's entire startups that are, beyond, seed stage, that are raising additional funds, that are specializing in just helping fintechs get onto platforms. And because you have to raise the bar, you have to have policies, you have to have processes. People, private credit firms, they underwrite the fintechs. They want to see, what are your underwriting policies? What is your data? What is this flow? So it's been interesting that this kind of overall, market need in terms of people who want return on capital, but also banks, kind of not serving as many people, that has all these knock-on effects in the ecosystem. And there has to be all these players that kind of rise. So it's a great opportunity for startups, and it's a great opportunity for people that come from big industries that kind of were focused on banking to go into these, newer industries and places where capital is being deployed, and solutions that meet the gap of, hey, it's hard, outside of a banking infrastructure, like, how do we do this? And we can obviously talk about some of the rails as well.
Where to begin? Very expansive and very thorough. And I actually learned a lot in that, in the narration and your explanation of, private credit, but also the technology that's addressing it. And I would turn to Eric in this. Is that, where do you see this? Are we looking at a situation that more automation is going to deliver more money to the right people, Eric? Or what do you see in all this? I mean, I have my own reasons to answer right away, but you always have some insight out of the box with all that information.
So I agree with you that Evan gave us a lot more than we can easily cover in a few hours, let alone 15 minutes. So thank you for that. So I'm not going to hit every mark right now because you gave many interesting points to pursue. But what came to mind when you were speaking, Evan, is, and Travis's introduction, there's nothing wrong with regulation. Its purpose is to manage risk. The problem we've had in previous conversations and on these podcasts is there's a disconnect between where regulation is and where it needs to be in the cyber world, right? We're looking at a lot of things that were developed when ledgers were literally written out in pen and paper. So that's kind of the gap. And now that the people who are in charge from a local or federal government, from regulatory authorities, they figure they would just squeeze the screws harder to get a handle around fraud. And the problem with fraud is it's growing near exponentially. It's the second largest economy in the world if you want to look at just how much is out there, right? What I like hearing from you is that behind the scenes with the private credit movement, they also are trying to mitigate risk.
Yeah.
And they are doing it from a much more practical view. And of course, there's a lot more on the line, but now they have to mesh that with industries they're not traditionally engaged with, right? So that's where you're seeing the startups or the glue there. What I want to add to that is this is a prime opportunity for the private credit interests to not only manage risk, but to de-risk. This is the time not to learn what's done and mimic it. This is the time to learn what needs to be done for the outcomes and to find new ways of ensuring that fraud is kept out. And I like that you mentioned a few years ago, it started to spike because with COVID, we lost that branch relationship. We lost that handshake and we assumed trust, and that's counterintuitive. So how do we start reestablishing the trust and getting that back into the conversation? And so your point about the many different databases people access to do research on entities, like two-person startups. You need to know who the registered representatives of a company are and where they are. So over the company life cycle, fine, they might start with 2, they might go to 20, the company might disappear, but those entities who were officers still persist. And you want to be able to say to them, hey, what are you doing now? Are they forming lots of shell companies, or are they actually in another legitimate interest, right? So you need to have some way of having KYC, KYB align and be consistent and persistent. And I think that's going to be interesting because historically we've never really had those tools.
Well, what dawns on me with both the conversations, we live in this prior, when you say that the ledgers were written out on paper, I'm visualizing that. What has happened is with all this automation and digital transformation is we have, like you said, Plaid. Plaid can take all this information and correlate it and say, boom, there it is. We think it's this and everything else. What I do believe is missing is the granular, non-static. So the prior, everything's been static, right? Now we're in this very fluid verification where we need very kind of almost micro verifications across information at all times because things change so dramatically. And especially with someone in the wild, it's a two-person shop, very valuable, very trusting, good standing people that want to get money to. But I do believe the verification process is out there right now to be implemented, and it's not on a global scale. And we see, corporate docs and certificate corporations and shareholder agreements or bylaws and things that are customary to have state, federal, and county and records to all align, and the person's ID. We need constant and continuous perpetual type verification of this. And on that subject, through all this, do you think, Evan, is some of that verification in a secure environment might assist in the approach that these wonderful companies are deploying this capital?
Absolutely. I mean, there's a few things there. One, on the onboarding thing, you're absolutely right, where there was always this binary onboarding where it was really hard to get in, but then once you get in, you never look at them again, and they're kind of with the sales team now. And I think that touches on, a few other things you guys were mentioning, which is, the additional data that you can mine and that you can layer on. It's not just financial data. It's not just Plaid that you can use. And I think that that's where a lot of the younger and, some of these companies that are starting up are doing a great job. Behavioral data. One of the things I look at is some of the observability platforms we have when a user comes in to do something, and we can say, wait a second, where is this person logging in from? How long were they on the platform? And you can actually start to use some of these, customer experience type metrics on where do they go when they go to the app? Do they go straight to financing every time? Do they look at other things? Are they changing their, some of the indicators we look at in terms of where's the money going to? Is it going to a card that they own or a bank account they own? It's not just, when you're underwriting people, you're not only underwriting their financial performance, but also their behavior, the use of proceeds and stuff like that. And to give you, I think you guys will really like is, private credit, what are they looking for in these fintechs? And you would think, show me the loan tape, of course, show me the historical defaults. But the number one thing in my conversations, and not just with Tola, but other companies, is that they want to understand your go-to-market. They want to understand how.
That's a whole, well, you're talking about behavior. That's a whole new dimension. I didn't even think about that. Yeah.
That is one of the main things. And you will actually get private credit firms that will, if they don't like your origination, they're not interested, even if you've got great loan tape. Right? Even if you've got that, because as they think of taking a fintech from doing a few $1 million to doing, closer to 100, they need to understand how you're going to scale. So yes, they want to make sure your balance sheet is solid. Yes, they want to make sure that the underwriting is solid. But one of the things that really surprised me, and it's brilliant, again, private credit guys are fantastic operators. They really want to understand, how are you getting customers? How are you acquiring? Where are you meeting them? And then are you meeting them at conferences? Are you doing it via ads? How many are referrals and stuff? A lot more of these kind of growth metrics than I ever thought. I thought, hey, this is cut and dry. What's the historical default rate? You throw stuff in the model and go, but they'll spend a lot of time going deep on that side, which I think it just shows the high level of sophistication, but it's also really smart because, and this is something I've felt a long time, especially for early stage companies, your go-to-market is your credit risk origination. Who you are going and where you're finding people, that your credit risk approach has to conform around that. Because one of the big trade-offs here, we're talking about a lot of good things about people doing this. One of the trade-offs is that who suffers the most friction in this world of more KYB, more compliance, more sophisticated, more data required? It's the good customers. It's the great business owners that have businesses that don't really, have time to go through all this. They need the capital. They have a great business. They don't want to spend weeks and weeks doing it. That's the old process. Now all of a sudden they have all this data that's required, and it's like, hey, I've been running my, we had an amazing customer. He was selling ergonomic chairs out of Chicago for 30 years, right? Very pioneer in the industry.
Sure.
And he said, my rates have never changed. It's always 20% is what people are showing me. The market's been up, the market's been down, but what is required for me to get access to capital is just rising. And hey, that's a cost of your time. That's a cost of your business. And then the other thing that I wanted to make sure I touched on, just in terms of the evolution of this over time that can't be understated, is when a lot of these early fintech approaches to lending and creating models and optimizing this, they were done in a zero interest rate environment. So you needed a lot of growth. There was this premium on growth, and you could be more wrong. Now, as rates have risen and capital is more expensive, private credit firms are raising at higher levels. Their cost of funds go up. That means the fintech's cost of funds go up. That means that you have less room, less flexibility. All of a sudden, defaults hurt a little bit more in a higher rate environment.
Well, it dawns on me that's very loaded information is when you talk about binary and the rest of it is, one, you let someone in the door, right? Then, the application you get through, them. But knowing the intent and their business operations, I mean, if we could know that the CFOs at the crap tables for the last 2 days, it's not a good indicator, right? So knowing
Travis, what I see, I mean, I don't know, this maybe we're sharing a little too much here, but I've opened up, businesses, and these guys are telling me all these amazing things they're doing. You look at the transaction, you always look at the bank account, you look at the transactions, and I'm like, I don't see any, one of the things we look at is like, is this business doing what they say they are? So sometimes we'll get it up and it's like, okay, there's a lot of personal expenses here. I'll never forget the time. Sorry for, your audience, but when you open up a transaction history and you see someone using a business bank account for OnlyFans, that was surprising to me. That was probably an indicator of a high risk customer, right? So some of these things, you want to make sure that, is this business actually doing? And I think that what we try to do is we try to say, hey, it's, there's going to be, fraud is inevitable. Having these people come in, having people running operations, it's pervasive, it's inevitable because it pays, right? We can get into some of that as well. But what you don't want is it makes great customers more valuable. right? So when we see a customer that has a great bank account, that has a great track record, I'm willing to tap our sales team and say, hey, this is a person
Focus on
we're
these
spending
guys.
extra time on. So it's not just using this for bad stuff, but also to show who are the great customers.
Well,
Yeah.
Go ahead, Eric.
Yeah,
Please,
just
Eric.
a quick point. As we warned ourselves, this conversation can easily run long. But just getting back to a couple of things that have been brought up again, just to fold back on itself. You mentioned all the different data sources, and you said Plaid has its purpose, and there are other ones out there. We keep talking about having to cull all this information, but we also need it more quickly. We need it in real time or near real time.
Yeah.
And we need different cuts. We need different perspectives. Because as things evolve, nobody was looking for OnlyFans as a problem 5 years ago. It didn't exist 5 years ago.
That's
right.
That's
So,
static point. Yes.
yeah. So we're in this place where it's beyond outdated regulation. It's beyond outdated risk assessments. And these things are also dynamic. So as somebody thinks of what could I see, they first have to understand the universe of information they could pull on. And that's going to be much more and more personal going forward because of the relationship between all corporations, even if they have agentic AI in them, at the core are people and
Yes.
officers. And there is the corpus. It's not just the startup, it's the health and that's that guy who's making the ergonomic chairs for 20 years. He is great he on many accounts, and he should be recognized for that. Until one day he isn't. Let's hope that doesn't happen, right? Or there's somebody else who has shown the growth, right? And that should be rewarded. And the last thing I want to say, which is not really in scope here, there will be net new opportunities beyond the traditional credit, beyond going through the big three creditors. When we start looking at microfinance, we start looking at developing markets and developing economies. This should not follow the path of our past. It should be part of this new future.
Well, I think, Eric, just to that point, if you have continuous monitoring of your clients, the good clients, the bad clients, and the rest of it, then this will reach a level of precision to be able to get that promise going out there. And I do think it is continuous. It's not static, as you say, Evan. Binary. This is something that has to be, critical decision making through all the data flow. And we live in a data world, right? With all this quantum and AI and the rest of it, let's put it to good use. So, we keep these to 15 minutes, so we're getting there. I would say this is really kind of a punchline from my perspective is that this is we're gonna have to do a follow-on episode and really dive in. But I'll ask this kind of going back to the beginning. These default rates are really, interesting and so on, but really, how much fraud is really happening from your perspective? I mean, it maybe as a general, in let's call it digital, non-face-to-face transactions and private credit, or what you're saying is we're seeing Bloomberg 9.5 trillion in cyber. It's much more than that, I believe. But what are you seeing hands-on, Evan? That is it alarming out there, or are we all okay?
I think it's alarming. I think it's alarming. I think in terms of how bold people are willing to be is definitely. I've been on calls of this nature with people that are impersonating businesses. I once was doing an onboarding call for a business that had his fake business's name and a neon sign behind him. Like that's how far he was taking the con, right? And I think that willingness and how they're willing to get on calls, they have information, they have stolen, social security and EIN document, they really, this stuff is out there because of these data breaches and things of that nature. So the sophistication is just significant, and they're very disciplined, and I think that's why it can't be binary, because people know how to put on a good face and get in and then be patient and then make their move. They'll come in, do legitimate transactions. So that's really where you have to, again, look at all these different indicators. You can't have this one size fits all approach to doing this. And to tie it back to another thing private credit firms look at, and misconceptions I had coming from Wall Street, I was always, hey, we're going to build automated underwriting, we're going to automate all this, and someone can come in and some of the firms were like, whoa, we don't want zero humans in the loop. We don't want full automation. That's not fun and sexy to us. That sounds quite dangerous, actually. That's how you're going to lose our money, because to your point, how are you going to make sure your model is going to conform? So if you do have those automated approaches, then it becomes much more about how does model back testing work? How do you change the weights? How do you do customer segmentation? So it has to be that living, breathing thing. And so I think, hey, there is a ton of fraud out there. you can catch it at different points. I think the amount of fraudulent signups is a lot different than the onboarding flows. And I think that that's where, people can be like, oh, the requirements are so crazy, but that's where these BaaS providers have gotten it right. And that's where the private credit firms get it right, is that they do hold a high bar. As we are in this world, and as fraud is going, there has to be a high bar. And I think that that's the kind of, to take it to a positive note, yes, there is, rates are higher, fraudsters are there, there's lots of new tools. I mean, some of the stuff that's going to be available with AI and impersonation, some of the companies I'm looking at that are able to redo voices, and so it's going to get more sophisticated. But the punchline on the positive end is that what firms are able to do now, smaller operations are able to do stuff that it used to take teams of people at banks to do. So there's a lot more the potential for private credit firms to deploy capital in a thoughtful way, in a way that gets to the customers, the precision that we can have in go-to-market, going after specific customers and finding those customers, meeting them, building products that speak to them, that work for them. What is possible is just incredible. And so there's a lot of things that need to be done, but the positive is that when we figure this stuff out, and for people that are able to bring together, technology, but also know-how, and bringing some people from more traditional backgrounds and infusing them into that. Every fintech I have known has experienced people in it, that are people who've been at Capital One and people who've been at big banks, who are coming and infusing their knowledge in it. And something that, hey, I'm obviously, it's what I've done, but I'm very, very positive, people who are in banking, people who are in these private credit shops, I'd encourage them, hey, look at opportunities in the fintech space, look at opportunities not only at companies doing lending, but also this ecosystem around onboarding KYB, because we need people who really have seen risk in different dimensions on the front lines, helping build this technology. And once it opens up, when things work, and you look at, hey, wow, what were 20, 30 people able to build and originate groups that size, they're originating hundreds of millions of dollars. I mean, that's a profound jump from where we were in the mid 90s, early 2000s. And that's the beauty, is that you will have these operations that, if they can get things right in this difficult environment, the tools we have at our disposal are also better than ever before. And so that's why, get out there, do things the right way, find things, do it, and just know that your job is never done. I think everyone wants to build something, set and forget it. Who doesn't love passive income? Private credit's not a passive income business. It's
hard work. It's hard work, right?
It's hard work, and you have to be into it. You have to want to help these businesses. It has to be, dealing with the fraudsters isn't fun, right? And especially when they try some scheme you haven't seen before, and they expose vulnerabilities. Some of it can be good, some of it cannot. But it has to be worth it. You have to find the group of customers that you really want to help, because the good news is that some of the businesses we've gotten to work with and see them grow and see them getting a bigger and bigger store, it makes it worth it. It makes dealing with all the nonsense worth it. And you can't, it's not to get religious, but it's a Sodom and Gomorrah thing, where it's like, we can't, because of the fraud, we can't let this small business ecosystem suffer and have onboarding horrible and rates go high. We need to find a way to do it where the great businesses get rewarded for being great businesses. I think we can do that.
Yeah, and and we tend to, at the end of these episodes, which is great, is that we start with a negative, plot and the rest of it. But at the end of the day, we do our job right. And this is where I'm going to, wrap it up here in a minute or so, and I'll go round robin, is that, I always like to look at the positive things in the future. And if we do it right, we can get the capital, everyone can make money, they can have prosperous businesses and whatever they do, and not mess about trying to get money when you need it for earnest and real applications in business. And so I see a future where, we can solve that 5 trillion or plus trade finance gap and these things where people and all that. And Eric, maybe I'll leave it with you. What do you see? We've got a combination of flows here. And I want to say is, we do need human process and business process and AI process to be in harmony. I'm going to leave that utopia of the future to you. You're very wise at kind of the outlook of things. So we'll end on a positive where Evan started. And Evan, I'll win with you on that note, but we'll start with Eric. Eric, what do you see in the next 5 years?
Oh, we will be using a lot more AI. We will be implementing a lot more automation. We will not, hopefully, have it autonomous, fully agentic. The concepts that you see the industries, the tech industries going after, is interaction with these services. It's not like you're going to have responsibility to an agent. The agent will be something that works with people, or a group of people, and it's going to be giving that insight hopefully in real time or near real time. So it's going to be much more of a dynamic experience to interact with the data. And you can also have other agents who are going to go back and start cleaning out data and looking at the trends that Evan was outlining about behavior and helping people who are inside the ramparts, be brought back outside by maybe the cuff or the shoulder. And then we're going to have more of a clear line between an entity and its officers and or the actions of those officers. And getting back to the point I made earlier, and that is, this is a phenomenal moment in time following COVID, following the realizations of the 2022 cataract, right? That this is a chance to reinvent business. And with the private credit interests, if they seize this opportunity, they can de-risk, and I used that term earlier purposely, they can help de-risk these new services that they are entering into. It's a very good time. We then will have the regulators, not the question of catching up, but understanding what's happening. And one day there'll be new regulation. But until then, the industry will take care of these industries take better care of themselves with their interested parties, these private creditors taking a more active role in understanding how to de-risk.
And Evan, give me 30 seconds to 45 seconds on how you see the next 5 years, looking maybe at what we want to accomplish.
I think the beauty with some of the private credit stuff is that the incentives are better aligned. When you have someone at a big bank who's one person in a 50,000 person organization who's in charge of fraud or in charge of underwriting, working a 9 to 5, hey, really tough job. It's a lot different when the firm has their capital on the line. So I think this idea that incentives are coming closer and the people who have the capital are getting closer and closer to the origination and the fintechs, and bringing that accountability from a place of this is good for our return profile, not this is what we need to do. It's aligning with regulation. Everyone wants that. And so where things are really going in the next 10 years, and I think we're starting to see that, is the opportunity where a lot of risk and fraud, it's been about identifying bad actors, stopping the bad actors. But I think now there's going to be so many bad actors, and there's going to be so many dimensions of bad actors, because there's going to be so many that it's going to be something about, hey, how do we allow people to show they're positive? How do we show what are the positive indicators? What can you opt into that proves to someone you are who you are? So simple things like holding up your ID and things of that nature, stuff that's tougher and tougher to go and do fraudulently. But I think that I'm really excited some of these approaches in terms of digital footprints and eSIM, some of these different things that are going to come up that allow the great people to really improve that quickly, and not with doing Zooms, but with more fundamental technology that is able to say, hey, I am who I say I am, and I'm giving you access to stuff that is impermutable, and it can't be faked by AI and things of that nature. I think that that's what gets me excited, and I think all the incentives are aligned for us to go out there, because one of the other things is like, hey, there's a lot of people out there who want to start businesses, that want to get involved in the economy, and so we want that to happen. We want younger generation to buy businesses from boomers that are trying to retire, and they're going to need to finance that, and they're going to prove who they are. And so I think that there's such a big incentive out there that this market, this generational trillions and tens of trillions of dollars in wealth is going to move through businesses and through as people kind of move on. Like, it's going to be this opportunity to, hey, can we bring these tools and can we bring the capital and do it in a way that allows businesses to grow like they never have before, and also grow over time and have more dynamic access to capital, where it's not take a $200,000 loan every couple of years, where it's something that's what we've done at Tola, where we're doing 30-day, vehicles. That's
No.
Private credit can do these ABL type things where there's just, in terms of the structuring, is so much more precise than throwing things on credit cards or on banking credit lines. We can have things that really, purchase order financing, factor, supply chain financing. And I think that these more sophisticated mechanics that were only available to large corporations for a long time, a lot of those people are coming down to these smaller parts of the market, and they're bringing very sophisticated financial instruments, but in a way that is more accessible with technology, that I think I'm hopeful is going to make capital deployment more seamless, and also safer.
Yeah, and I'll close with thank you, Evan. I mean, like Eric said and we said, it's loaded with information. We could go on for days about this wonderful information. I would like to leave our audience with this today. my goal and what I foresee is at some point within the next 5 years is that everyone will wake up one day and the criminals will not be able to access the money, right? The ultimate power is a collective good people making the fight, and it comes from all different angles of collaboration and collective intelligence, and it's machine and human and the rest of it. So I look to the future of peace, no access to, criminals getting their money and the rest of it, and having the future generations thrive and keep this entrepreneur. And that's what the US is built on. And the rest of the economy is kind of following that. So thank you, Evan and Eric, for this wonderful episode. Very, very wonderful information. And as always, to our listeners, this will be pushed out on LinkedIn and also our website and various email campaigns. And look forward to our next episode next week on episode 14. Take care, everyone. Thank you, guys.
Thank you. Thank you, Evan. Be well. All right.